welcome to The Money Program, a show about dollars and cents. I'm your host, Kate Sullivan. With the end of the year just about here, everyone's going to start thinking about their taxes for next year. Taxes always have that conception of very difficult, very hard to do, very strenuous. But today we have with us Bill Kearns of Cullen & Murphy. Bill has over 30 years of accounting and tax experience, and he is going to help us get through some of the basics and figure out what you can do now to start making that tax season a little bit easier for yourself. To start off, thank you for being here.
Thanks for having me.
What exactly are taxes, like just in the basic sense?
The basic sense of taxes are money that's taken out of your paycheck to fund governmental operations.
All right. Now, I guess that's what makes them important, that they're funding all these types of groups and organizations. How do most taxes work? Per payment of it or taking them out of your paycheck?
Typically, most people get a paycheck, and from that paycheck is taken out various types of taxes. Social Security tax, which is used to pay Social Security. Medicare tax, which is used to fund the Medicare system. And federal withholding is to pay your federal government taxes, and then state income taxes is used for state government.
Great. What are the most common types well, we talked about some of the taxes, and those kind of fall under like income taxes. Correct. What are other types of taxes that people need to be aware of that they're paying or that they could need to pay at some point?
There was always capital gains tax. So if you own stock or if you own real estate, any type of investment property, and you sell that property, there's capital gains tax. That's assessed at typically 15% federal and 5% state, although that can change depending on your situation.
Mm-hmm. Now, to correct me if I'm wrong, that is the tax on the increase in value, correct? Versus what you purchased it for versus what you're selling it for. That difference in there. Great.
Correct.
And how does sales tax, like when you're buying things, does that play into it at all?
Not really. That's a tax that's assessed by the government that's used, again, it's just another tax to fund operations. I don't really get involved in that too often. Some of my corporate clients, it can be very complex with corporate clients, whether or not they're supposed to collect it and pay it or not. But typically it's, right now it's 6.25% of anything that's taxable. Mm-hmm. And the definition of taxable can be extremely complicated.
A lot of gray area on that sometimes. So when you're talking about income tax, and that seems to be the most common that would affect most individuals that are working or doing any kind of, they're employed some way. What covers income? Like what is considered income? Well,
typically, wages, number one, would be income, and then there's other income that could be earned, rental income if you own rental property, interest income earned from banks. If you have stocks and mutual funds, there could be dividend income, and if they're mutual funds, they generally will have, within the mutual fund, they'll buy and sell different stocks throughout the year, so there'll be capital gains built within the mutual fund that you'll have to pick up. If you're collecting Social Security, a portion of that could be taxable. If you're collecting alimony payments, that could potentially be taxable. Retirement income, if you're collecting retirement income, that's also an income item. Royalties, if you collect royalties from anything, if you were doing like an actor or something, you're getting royalties on some work that you did, that's the taxable item. Those are the major items.
Now, what about some things that are considered unearned income tax? Is that?
So unearned income is income that you didn't necessarily earn from working. So interest income you earn from a bank is just money earned because you put money in the bank. Dividend income is considered unearned income because you didn't do anything to earn it.
Just kind of that money that just comes to you. Well, how would that follow under, like gambling money or lottery revenues or?
Yeah, that would be considered unearned income because you didn't work to earn it. You took a chance at gambling and you happened to win it.
Yeah.
But it is taxable income. Gambling income is taxable.
Right. So when it comes to personal taxes, at the end of the year, what are the very basics that people need to know about starting your personal taxes? There's refunds and...
Right. The first thing I recommend is to pull out last year's tax return. Because almost any tax preparer will tell you that's the first place we look is last year's return, because that's kind of the guide as to, roughly most people's tax returns don't change year to year for the most part. So that would be the first place I would look and look and see what did I have for W-2s and do I have them all? Am I missing any? Was there any, oh, look at all the interest statements I got last year, and do I have them all? And if I'm missing any, why am I missing them? Did I close the account? You know, dividend income, the same thing. So just go down the lines and make sure you have all that stuff for this year. And if you don't have it, just make a note as to why you don't have it. So then the preparer won't call you and say, you know, last year you had this dividend, but this year you don't.
Yep. When it comes to refunds, that's the big thing with taxes. People love getting big refund checks. What are your thoughts on that? Because there seems to be a lot of back and forth of, you know, it's great to have a big refund if you're not maybe a great saver, or you could use that little extra income at the beginning of the year, versus if you're getting everything right the first time, maybe you're kind of coming closer to zero, but you have more money in your pocket.
I have this discussion with a lot of my clients all the time. A lot of people do like that big refund. I'm not an advocate of a big refund because, in effect, you're giving the government an interest-free loan. I'd much rather see you take that money, have it put into a savings account, even though the interest rates are real low now, but you can put that in a savings account throughout the year. You'd still have the money if you didn't touch it in April when you got your refund back, and you haven't given you have availability to it in case something happened during the year and you needed the money for an emergency, versus wait until April. You know, what if you had an emergency halfway through the year and you couldn't get it till next April?
Yeah.
Money's not available. One of the things I tell people all the time is that if you're getting that money and just putting it in a savings account, why not just put it into your 401k or your retirement plan, and then the income grows tax-free, and you've saved the tax and you haven't given the government that money.
Yep.
And you've started to fund your retirement.
I mean, personally, I'm a person that likes the refund, because it kind of helps you. It's like a savings plan, but I get what you're saying, that you're letting somebody use the money tax-free in a sense, and you're not gaining any interest on it. You know, they're not paying you interest, or anything
Right.
to use that money for yourselves. So when it comes down to deductions, because that's the next biggest thing you hear often when people talk about taxes, what are common deductions, and how are they different than credits? Because sometimes you hear both of them. I think sometimes people use them a little bit interchangeably,
Right.
that they're the same, that they're kind of the same thing, but what are the difference and how are they, used?
Well, the most common deductions are, for homeowners, you have mortgage interest and real estate taxes. Those are the two big ones. And then, there's charitable contributions, and you get a deduction for any state income taxes that you paid as well. And the difference between a deduction and a credit is a credit is a direct reduction of your tax for the most part. So what that means is a deduction, let's just say you have a $1,000 deduction, you're in the 15% tax bracket. Well, that deduction saved you $150 in tax. But if you have a $1,000 tax and you have a $1,000 credit, your taxable income is now zero. So you're getting a $1,000 benefit versus a $150 benefit.
That's definitely seems like it's the better option to get the credits where you can get them in a sense.
Yes, yeah. A credit is usually 99 times better, but most of the credits you have to qualify for. The earned income credit, you have to have relatively low income. There's a child income credit, but again, it's all based on how much income you have.
Now, when you talked about some of the deductions, in the most common deduction being for people, the deductions around home expenses, so your interest you paid on your mortgage, your property taxes. What about those who rent? Boston, there's a lot of renters. Are there any, tax
Unfortunately, on the
considerations?
federal level, there's no deductions for renters. Massachusetts, however, does allow a rental deduction with a maximum deduction of $3,000. At 5%, it's worth $150. But it's $150. You wouldn't have otherwise. So,
$3,000.
but unfortunately, the federal government doesn't give you any break for that.
Yeah, $3,000.
But you do get everybody. On the federal side, you either itemize, which would mean you deduct your interest and taxes. But if you didn't own a home, you get a standard deduction, which for a married couple is $12,600, I believe, in this year.
One last topic about the home expenses. What about those folks that are paying PMI, the private mortgage insurance, on their homes at the time?
Under the new tax law, that is deductible depending on your income limits, and it will be reported on the form that they give you, and then the taxpayer will put it in and it'll calculate whether or not it's deductible.
Okay, great. And how about job expenses? What?
Job hunting expenses are deductible. Typically, job expenses are only deductible if they're for improvement of your job. If they're a requirement of your job, they're not deductible.
Okay. And I guess also student loans, some of the student
Student loan interest is deductible, again, depending on income limits.
Okay. I guess the last big thing in terms of deductions are charitable contributions. Are there any guidelines for that?
Well, the tax law on charitable contributions has gotten much tougher over the years. You know, years ago, it used to be people just gave you a number, you could put it on a tax return. As tax preparers now, we're required to ask the question, do you have backup for these deductions? So what I try and tell people is use a credit card or write a check. Try not to give cash, or if you give cash, get a receipt. Because it's required by law now that you have to have that backup.
Are there any concerns over, you have to make sure that they're a 401c3, or can they?
Typically, the only charities that qualify are 501c3s. There are some exceptions, 501c4, 501c6, and they would typically tell you whether or not it was tax deductible.
Okay.
It's required of the charity to let you know whether it's tax deductible contribution or not.
Great. And what are some of the common credits that people should be looking into for themselves?
The biggest credits now are the credits regarding education. If you have kids in college, there's the American Opportunity Credit, which allows you up to $2,500 credit. That's kind of a split credit, like I told you before. Some of the credits are refundable and some of them aren't. So that credit, up to $1,500, could be refundable, so it could be added to your refund.
Wow.
That's a big one. Then there's lifetime learning credit, which is for people who are taking graduate classes, who don't qualify for American Opportunity Credit. And then there's also a tuition deduction. If you don't qualify for either of those, you can deduct up to $4,000 of tuition. And most softwares now, you put the information in, and it'll maximize which is the best option for you.
Oh, great. What about childcare? I mean, childcare is so expensive in the city and in Massachusetts. How does childcare?
There is a credit for childcare. It's limited. It's very small. Typically speaking, it's 20% of whatever you pay, with a maximum of $6,000. So up to $1,200 would be the maximum credit. And again, it's based on your income. And you also have to take out any of the stuff that was taken out pre-tax.
Yeah.
So if you have a plan at work where the benefits come out, that has to come off the top of what your expense. It's
And
only
then-
allowed on after-tax dollars.
$6,000 is not an incredible amount for taxes in this, especially if we do the $5,000 maximum pre-tax. What things are not considered deductions? Like what can people think or used to be deductible that are no longer considered deductions?
Well, interest, personal interest, so credit card interest, interest on car loans. Those are the big things that people always send it in and say, I got this interest expense, and that went away probably 10 years ago. The only interest that's deductible now is mortgage interest.
Yeah. What about like political contributions? I mean, there's always a big political
Political
scene in
contributions
here.
are not deductible, unfortunately.
No problem. And how about some of the things associated with your home? Like what is not deductible in terms of your home? Like homeowners association dues?
Right,
or-
home insurance is not deductible for the most part. When I say for the most part, is if you had a home office, some of that may be deductible if you use an office exclusively for business. So your property taxes and your interest would be deductible. But homeowners insurance, utilities, cable, internet, all those things are not deductible.
Great. You mentioned a little bit earlier about pulling out, starting with your last year's tax returns. What can people start doing now besides pulling out their last year's returns to start preparing, for this upcoming year?
For the taxes, you mean?
Yeah. Yes.
So what they should do is start looking through their checkbook to see what they wrote for charitable contributions, excise